We're just gonna give it a couple more minutes as people filter in.
Is that my friend Sarah? I got your text.
Good morning, Christine.
Good morning. I was thinking about you just yesterday too, and I wrote you at the top of one of my pieces of paper. And I was like, Sarah, Ioli. And later in the same day, you texted me, and I hadn't gotten back to my paper to show you that just yesterday, I'm like top of the paper, first thing was you.
Well, I feel honored, and it's funny how those blessings just seem to happen.
Exactly. And then look at, here we are.
Here we are, getting smarter together. Good morning, everyone.
Morning.
So it looks like there's still a good number coming in, but
As we're waiting for some more folks to hop on, I think it's, first of all, it's wonderful to see so many familiar names and faces. You know that we do these new sessions based on feedback we get from you as far as what topics might be of interest. And so throughout this time, please feel free to drop in the chat any future topics you'd like covered. Looks like the waiting room slowed down a little bit. So if you'd like, we can go ahead and get started.
sounds good. You ready, Christine?
I'm ready.
Wonderful. Well, thank you again, everyone, for being here, albeit virtually. It's kind of a dreary day out there, so hopefully this brightens up your day a little bit. I'm going to let Tom and Christine go ahead and introduce themselves because they're better at it than I am. So take it away.
Thanks, Danielle. So it's nice to be able to do this presentation with our former board chair and estate planning attorney here locally, Christine Woodcock-Detter. And, you know, I'm Tom Griffith. I'm the Vice President of Development. I was a financial advisor for about 7 years before moving over to the Community Foundation almost a decade ago. It'll be a decade on January 1st. And so this was one of those presentations I started doing shortly thereafter. And it definitely is a wonderful thing to get to talk with the nonprofits that are participating in the Essentials or Education Workshop Series and be able to spend some time on this important topic. And I guess I'll leave it at that for me and let Christine introduce herself.
Well, good morning, everybody. So we are happy to see all of you. We do have one sole participant in our audience, so we do have, if we start talking,
She's off camera.
if we start talking this way, it's because we have one live person. Anyhow, I'm an attorney, so I am a trusted estates attorney. I'm a partner. I'm on the management committee these days at Bousquet Holstein, which is 2 blocks that way in the One Lincoln Center Chase building. I've been there for a long time now. Since about 1996. I was thrilled to serve on the board here at the Community Foundation for 6 years, board chair for 2. Right about the time that we built this building. And so what we're doing today is actually was a dream of ours back then, to be able to pull together the resources of the Community Foundation and in the community and provide education and training for our not-for-profits on a variety of topics. So I'm here to lend a hand, provide some comic relief from time to time, entertainment, and to bring the perspective of a trust and estates attorney who is either serving on your board many times, as you guys know, or maybe not a trust and estates attorney, but attorney serving on your board. Or many attorneys bring clients, donors who have charitable intentions to Tom at the Community Foundation. So I'm here to do what I can and help explain and describe plan giving, endowments, lots of stuff about the Community Foundation, and to try and help you guys start thinking about planned giving, different than annual giving, but start thinking about planned giving and how you can bring that to your organization. Because for the long term, that's where it's at. That's in large part how the Community Foundation endowment has grown like it has.
We'll go ahead and start the slides. Sorry about that. I'm actually gonna share my screen first. And then start the slides. Yeah. All right, can everybody see that? Good, all right. And a couple of just mechanics things. First, I'm gonna take my jacket off because this room's a little bit warm. And secondly, we've already been formally introduced, so first impressions have been made, so.
You look good, Tom.
Okay, thanks. And then secondly, I want to let everybody know, we'll try and take a break probably a little bit after 10, just do a short bio break then. And we'll aim to definitely be done by 11:30, if not a little bit earlier than that. So, and so we did our introductions. It's great to be here today.
One thing we should add, we do have Danielle and Corey monitoring the chat just because we're the talking heads here. We do have folks monitoring the chat, so don't be shy.
All right. So let me just start off by saying that, this level setting sort of what a community foundation and why we're here today for this at a community foundation. So first, we're a tax exempt public charity. We've been around here for 95 years. Over that time, we've received many gifts from many donors. We manage and invest those so that they can grow and keep pace with inflation over time and still do good work year after year. And then we distribute those charitable funds through our different community grant making and strategic initiative work that we do. So every single fund that gets created here comes with a donor purpose. So the donors get to choose. So when your donors come to work with the Community Foundation on a planned gift, which might be something that happens, they can do that and have it be in support of your nonprofit. So that is a very common thing that we do. And so many donors come to us with their list of maybe 2 or 3 or 4 favorite charities. And that's the kind of fund that we create, is one that supports those as long as they're still around. So we have a very local focus. We focus on what's happening here in our community. And we also do a lot of work to convene local nonprofits, which I'm sure many of you are already familiar with. And that's what brought you here today. So, our core mission is growing permanent charitable endowment dollars for local nonprofits. So that's really the focus of today, is the concept of creating endowed dollars and how that might work and how planned giving is an essential part of that. A piece that we'll touch on throughout the presentation is around personal legacy and how that's a very important part for when you're having planned giving discussions. The people that love you, want to support you, and have supported you during their life want to support you after they're gone, and being able to have their story as part of your nonprofit story is critically important to that work. And just in general, we are a resource for personal and family philanthropic planning and complex charitable gifts. And, we'll talk more detail about that, but there's a lot of these things that we're going to talk about today that are just easy for you as an organization to implement. But there's going to be lots of things too that will be complex, and you need to know where to go to for help. So there's other resources besides the community foundation. There's planned giving specialists throughout, some of your organizations may even have like a national overarching umbrella that has a planned giving capability. You could hire your own planned giving capability in-house. There's some national and local council organizations that provide support. We at the Community Foundation use an organization called PG Calc as sort of our back office for complex gifts and for calculation software. There's other marketing kind of firms that help you get the word out to your constituents about planned gifts. An example of that is Crescendo, that's nationally available. There's other publications, American Council on Gift Annuities. I mean, basically, like, there's just a lot.
I would say, Tom, on this list, so you don't have lawyers on your board, lawyers in your community on your list, but they can be tremendous resources. My favorite is on this list for a resource with sort of big topics to learn is the Planned Giving Design Center. That's traditionally been very, very good.
Yeah, it's got a lot of really good information on the site that's useful to just as you go through doing things there. And yeah, I totally agree. Professional advisors, which will also be a theme, the professional advisors that you have as an organization and also the ones that your donors use are absolutely key to getting the word out and getting some of these gifts done. So this is just a little cartoon. For a long time, since income taxes were created about 105 years ago.
Wasn't it 19?
Was it 14 or 17? I
I
can't
was
remember.
thinking it was 16, kind of in there.
Yeah, somewhere in the mid-teens, about 100 years ago, they invented the income tax, and with that came the charitable deduction shortly thereafter. And so it is more blessed to give than to pay taxes. So we'll just always keep that in the back of our minds. I'll also note that taxation is a big thing with planned gifts. So it's important to do them. It's important to do them in the context of your donors' financial and estate plan in a way that is very aware of the tax impacts, because it can make a huge difference. And there'll be a couple of examples in the presentation of that. But I just wanted to note that is, even when a donor just gives you a check, for their annual contribution, that's a taxable event for them, and they get to deduct that potentially if they're over the standard deduction, and that's something that you really don't have to worry about. But when you're helping a donor with a planned gift or helping them work with their advisors on a planned gift, you want to make sure that part gets done correctly, because it can be really, the gifts are just bigger and it can have more of an impact.
Yeah, and I would only add that when your organization has a big donor on the line, usually the donor will have an attorney and definitely a tax account. And the driver, other than charitable intention, to benefit a particular program or project or endowment of your organization, the driver is taxes, more likely than not. Income taxes, presently, and I can tell you, especially as we head into planned giving territory, estate taxes. So you guys are probably not going to know what somebody's net worth is necessarily, but the tax advisor and the attorney will. And just so you know, estate taxes start in New York at about $6 million. So if you have more than that, you're paying estate taxes. At the federal level, it's about $12 million. So even in our recent past, it's been as low as $1 million, $1.5 million. And that's why it's sort of a political football you see. Every 10 years, that legislation sort of times out in Congress. And depending on who, when the musical chairs stop, depending on who's in control of the House and the Senate and in the White House, that's when you see the state taxes at the federal level become the political football. Because every 10 years, because of federal budgeting, it times out. So you may think, well, why in the world do we have to revisit this every so often? I thought it's already settled. Well, it's because they all have like a 10-year timeline on the estate tax bills and other revenue type bills. And then it's when the time comes, what's the political lay of the land and who's gonna get what through? So just know that and it makes donors feel great when they're in that bracket to be able to give money to your organization, either during life to reduce their income taxes or at death to reduce their estate tax.
Yeah, they much prefer giving it
Oh,
to
yeah.
nonprofits than the government, for sure. So I wanted to do a couple things here. First, what are you hoping to learn today? And especially if there's something that you came into the room today with that you were like, oh, I just need to figure this thing out. If you could just go ahead and put any of those kinds of items in the chat right now. We'll just take a break to, for about a minute to let you enter those things in the chat. What are you hoping to learn today? Or what was something that was just, you had to get this question answered? Go ahead and put that in there. And I'm hopeful that most of those things will get addressed throughout the course of the presentation, but we'll have them collected there so that we can address them at different points for Q&A as if we don't hit them in the actual slides. So go ahead and do that. And then I'm going to launch a poll question, and the poll questions are there. So while you're working on your chat, I'll go ahead and launch the poll.
Very cool. Very impressed, Tom.
Looks like almost everybody's been able to do the poll. I think I'm going to just go ahead and end it here. So on the first question, looks like a little over a third of you said that you don't receive planned gifts each year. 44% said you maybe get one or two. 15% get a little bit more than that. And then there's 4% of you that get 5 or more each year. So that's awesome. And when you look at the question about, are you now or are you planning to ask for planned gifts? About 3/4 of you say yes. A few of you say no. And then some of you are undecided. So, which is also pretty typical. It's hard to sometimes make that choice about whether or not that's going to fit in, and understanding exactly what that means from a workflow and capacity standpoint, can definitely be a decision process. So hopefully we'll get some of those questions answered today, but it's encouraging to see that 74% of you are already doing it or planning to start. I will end there and yeah, go ahead.
Okay. So this lingo, planned giving, right? So that's a catchphrase, that's the term of art, that's the term that we use for planned gifts, as you guys can see, either created now, which, remember, income tax can be the driver on that, or in the future. Remember, estate tax could be the driver on that. And some part of that gift, and we're going to talk about what kinds of gifts and how do you do it in a minute, but is planned for the future. And the fun part about planned giving is it's usually sort of painless to the donor. It's not like those annual gifts or gifts to the annual fund or annual contributions at year end and the letter and the mailing. It's not cash in the bank right now that is going to your organization. It really is a long-term view for the future of your organization. So the sooner you get started on it, because it's a pretty long pipeline, right? Like somebody's lifetime, no matter if they're 40, 50, 70, 80, 90, it's a long pipeline. So where I come in as a trust and estates attorney is that often planned giving, part of either with your financial advisor, your retirement plan, or your estate plan. So that means that the gift to your organization could be part of a will that then goes through the process of probate here in our court, in our surrogate court locally. That's the process of proving that, yep, that's Christine's will, and yep, this money goes to On Point for college. So that's what probate means. I think I already mentioned that probably there's usually an attorney involved. And the fun part is for you guys who have received planned gifts, it can be kind of surprising. Yet usually what happens is you receive legal papers in the mail and you have to look at them and review them and sign off, and oh, great, it says that we're getting 20% of this fellow's estate. Sign here, have it notarized, and return it to the lawyer for the estate. And then you wait, and you wonder, well, how are we doing on that? When are we gonna get the 20%? Is it 6 months? Is it 9 months, a year, 18 months? Could be that long, depending on what else is involved. So it's really a long game. And usually retirement and financial planning advisors are behind the scene, and certainly the attorneys are behind the scene. And the result is usually that your donor is including your organization largely in a will or in a trust, or if you're really lucky, beneficiary of a retirement plan account.
Yeah, those are the easiest for sure, because they happen as a matter of law that you just get a
No,
beneficiary
Right,
claim
no
form.
probate, no lawyers, no nothing, just fill out the forms and the money comes.
Yep, and that's great. And the thing that I just want to emphasize too is planned gifts, probably are for many donors going to be the biggest way that they've supported you. It's at that point where they don't rely on those assets anymore. And, it's just, even a relatively, small percentage of something, could be a really significant gift compared to maybe what they were doing on an annual basis. So an endowment fund is really a place where you put permanent resources so that they can be invested to grow and provide support each year. That is as I mentioned, our mission here. So right now we have a spending rate of 4.4% on our invested endowed funds. And so what that means is that somebody gave you $100,000 gift that was for a fund here at the Community Foundation, and your organization was designated to be the recipient of that each year, you'd get $4,400 a year. And hopefully that $4,400 a year will grow and keep pace with inflation, because that's what the $100,000 is invested to do, is grow and keep pace with inflation. But what that does is it promotes sustainability. I mean, it makes it so that no matter what, without going out to ask a donor for anything, or without going out to apply for a grant, or without, getting your state contract approved or whatever, you've got that $4,400 coming in. And, so it takes the market, the economy, the world out of the equation and just provides that sustainable, reliable support. The, other thing is that, your donors have a choice that they can make about how they want their gift to be used. We obviously encourage them to consider the fact that they may not know what's going to happen over the coming decades, and that what the greatest needs are then may not be the greatest needs now. And so, we make the case for, having them rely on you to, make that decision. And so, lean towards the general support side, as opposed to specified purposes, but that's not always what happens. And sometimes, obviously your donors, many of you are receiving planned gifts now. It's great. There's just certain donors that sometimes would prefer to give to an endowment for you at the community foundation. It just hedges for them any uncertainty about your organization or about the nonprofit landscape. So,
Yeah, let me just pause for a sec.
Yep.
That word endowment, kind of scary, tricky. What is it? The general rule, and you can Google it, right? I'll Google it, but it actually is a word that's in the not-for-profit corporation law. So there's a whole legal description in our statutes about what an endowed fund is, what an endowment is. That's the magic word. And as we probably get, it basically means if $50,000 comes in, well, you're supposed to keep that $50,000. You're not supposed to spend it down to 40. You're supposed to invest it, and then in the future, as it grows, you can spend the earnings on it. Now, remember, the spending rate here at the Community Foundation is about 4.4%. Then as high as 5, as low as 4. So that too is something to decide for your organization. The other thing is what to do with this. It says endowment, Christine. What do I do with this? Well, a lot of times there's either an agreement, or remember how these planned gifts come in to create an endowed fund. They're in a will, they're in a trust, and there's language surrounding it. And you have to abide by that language. Sometimes endowments are old, sometimes they get too low because of market performance. And so sometimes organizations don't know what to do, or they get stuck with an endowed fund in some way. Or sometimes, it's so narrow what the donor wanted to do that you can't do that anymore. So there's also this whole world where you're probably going to need a lawyer for your organization to work with you to help you navigate what to do with this pesky endowment fund. That word endowment designates a legal arrangement, and you got to know what it means.
got to follow the rules.
Right, follow the rules and how to navigate it. So where it's great for an organization, sometimes it can be hard to wrangle those endowed funds. But again, it's a long game. Planned giving and creating endowment, not for the next 3 years of your organization, it's for the next 10, 15, 20. So it's really the long game on all this.
Yeah, thanks, Christine.
Yeah.
Also, I failed to mention when I put into the chat, there's a little 1-page handout. And, Christine mentioned the language. So the recommended language that we use for a gift through a will or a trust is in there, as well as how you would name the community foundation as a beneficiary. You could create, mirror kind of things that have your organization's information in there. And in addition, on the second, the bottom part of that handout is just a short description of many of sort of the common planned gifts, the basic ones, essentially. There's a lot more. There's a lot of more complex ones, and even the ones that are on that list can get a little complex, like charitable trusts. But just gives you the sort of one sentence one or two sentence description of those more common things.
Tom, we did get a question in the chat. What are some of the determining factors for the spending rate?
Yeah, that's a great question. So, so we look at we actually, next week, in our finance committee meeting.
So it's a calculation,
Right.
it's a financial calculation, right?
So, we actually have every September in the finance committee meeting, we have a discussion about the spending rate. And what we look at is, we look at sort of long-term, two long-term things. One is long-term, investment performance expectations. So it's sort of like, what do we expect the different asset classes in our pool of investments to do? And then the other one is inflation. What do we expect the long-term inflation to do? And the reason we use long-term views of both of those things is because, you know, we're in the business of long-term funds, you know, so right now we're experiencing, you know, pretty high inflation, but that doesn't mean that, you know, the 10-year number has changed very much, or that it will change that much going forward, you know, depending on how we move out of this. Now, if we enter into the 70s or 80s and have a different situation with respect to inflation for a longer period of time, you know, that could become more of a factor in our determination. But what we do is in that September meeting, we net out those two things. We say, all right, if the investments are going to get this much, and that's our expectation, and inflation is going to be this much, what's the difference between those two? So if one's like 8% and the other is 3%, the difference is 5, right? So that gives us, you know, what is there to use from the fund. Some of that goes to the support fee that pays for our work at the Community Foundation, and then the rest of it goes to supporting the nonprofits that the fund was designed to support. So that is, that's how we do that.
Who brings the magic crystal ball to your finance meeting?
So the leading question that Christine's asking is that we have a consultant. So we've been using a firm. Their name now is Crucial Partners. They were formerly known as Colonial Consulting, but we've been using them since October of 1994. So we've definitely enjoyed a long-term relationship with them. They don't make choices for our pool, but they advise us, and we use that advice to make the decisions. But the finance committee of our board makes that decision, you know, all the decisions on the investment pool.
Again, you know, I didn't know that was every September.
Yeah, it didn't used to be. It used to be a little less frequent. But one of the things that we changed in a recent, maybe 5 years ago or so, we were looking at it and said, this is just something we should talk about every year.
Yeah, I agree. That's great.
Any other questions in the chat, Corey, that relate?
Yeah, there was a follow-up. It says you have a specific expense or a specific budget expense that is 4.4% is meant to cover. Is this the same budget line item each year, or does it change?
So I guess,
It's not an expense, it's a distribution.
so we distribute that amount. The 4.4% could change every year. It doesn't. It's usually stable for, you know, a number of years, because again, it's based off of long-term numbers. What the nonprofit does with it, you know, could, you know, I mean, if it's for general needs but the board's decided that it's going to support paying for the executive director's salary or whatever, you know, they could change what they use it for. And as I mentioned in the past, you know, earlier in the presentation, you know, hopefully that number will grow and keep pace with inflation over time. That's why we net out the inflation part, so that investment dollars are growing, so that they can be as effective 50 years from now as they are today. So in the case of the 100,000, hopefully, you know, the next year it's 108,000, and then the year after that it's more and more and more, so that, or at least in the long-term average, it's growing that way. And therefore the distribution that comes from the fund is hopefully growing that way as well.
And there was one more as well. What types of legal and financial entities other than a community foundation might hold an organization's endowed funds?
So, I mean, a bank trust department could do that. You know, there's some other advisory groups that, you know, will do that work. that, You know,
Well,
but mostly,
so you want us to tell you who's the competition
absolutely.
to the Community Foundation? Fidelity Charitable, Vanguard Charitable, Bank and Trust departments locally. You've got M&T, which is now Wilmington Trust, NBT Bank, Salve Bank as a trust group, most of the local trust departments. And when I say trust department, that means there's a trust officer who's in charge of an account with a living donor or sometimes a deceased. Oh, Tompkins Financial, Tompkins County Trust Company locally. There's a trust officer who's the person, and they administer the fund that your donor has created. And so you guys may interact with that trust officer, or you might get a letter from Fidelity Charitable that says, oh, we have a distribution to your organization, and you work with them. They probably are going to want to see your 501c3 IRS letter and maybe some additional information. But other, mostly it's bank or trust companies, but places like Fidelity, Schwab, Vanguard have created their own charitable fund. But at the root of all this goes back to your, there's a donor behind it, maybe living, maybe deceased. And who would approach you guys if it's not at the Community Foundation would be a trust officer who has a document, has the legal language, and is both investing the money that came to them. And then every year dealing, you know, attending to the income tax return for the trust, and then making a distribution to your organization. So.
And I guess the other thing too is a donor could just, you know, leave you money. And then you're a nonprofit, just like the Community Foundation is. You could go do the same thing. You could have your finance committee create an investment policy statement. You could go hire an advisor for that investment account that you create. You guys could do the management of that as an, you know, and follow the rules, you know, the New York State Prudent Management of Institutional Funds Act rules about, you know, how to manage that. Yeah, you could absolutely do all the same things that the Community Foundation does. You know, for us though, that's just our mission and purpose is to do that work, you know, whereas, you know, for I think pretty much everybody on this call, you know, besides the Community Foundation folks, it is not your mission. Your mission is something else. So that's typically, you know, one of the reasons why we would suggest, you know, that you consider the Community Foundation or some other, you know, entity to support doing that work, because it can be distracting. It can be, you know, a significant lift for your board. Anything else, Corey?
Yeah, we had one final question. Do you find it more effective to cover G&A expenses or to cover program grant making? Does it matter to the donors, and what's kind of been your experience with the Community Foundation?
So donors are great because they're all so unique, you know, and so they're going to have different ideas of what they want to go do. And so, you know, when you work with a donor that is going to do a planned gift, you know, you're going to get probably, or when you work with many donors, you're going to get many different things. You know, I mean, my hope is for you that, you know, all the dollars that are left to you are left in a way for general support so that your board can make those decisions about what's important from time to time. And how to use those dollars most effectively, you know, each year as the as your work progresses. But yeah, I guess yeah, it's a little hard to put that in a
What was that first word?
general operating.
Oh, that's your lingo. General operating, that's where the magic happens, right? When you receive unrestricted or very narrowly restricted general operating, so that you guys get to decide as a board what you want to do with it.
Okay. We'll keep the questions coming. We'll keep answering them as we go through time to time. Let's Yeah, so
Don't get stressed out about this slide. I know you all could tell, you could teach us about why we haven't found the time to focus on this plan giving.
right, and this is basically that, probably not even nearly complete as to the reasons why you may not, be able to devote staff and board time to talking about this, but hopefully by the end of today's presentation, you'll understand, why it's important, and at least that there are some relatively straightforward things that you can implement, basically today or shortly thereafter, that will help you address some of these things. All of these are real too. It's not that, these are excuses, these are absolutely just things that you have to sometimes, deal with. And, both Christine and I have worked with nonprofits to help them through these issues, these obstacles. And, would be happy to, work with anybody that had, questions about that as well. So I won't spend any more time there, and instead I'll go into sort of the more happy thing of, where does your money come from? Where are these revenue streams that you have? And so some of you might look at this list and say, oh, there's only one revenue stream here for us, or maybe there's a bunch that you do already. But the ones that we wanted to highlight, are the last two, and that is, if you start asking for planned gifts, and even if you don't, you probably are going to receive them from time to time. But if you do start asking for planned gifts, you're probably going to start receiving them more frequently. And that will become, a source of revenue. It won't be, even though the word is planned, it's planned, with a question mark, because you don't know when that, time is going to be that they come. But if you ask for them more frequently, you're going to get more of them, and your board will then be able to make decisions as those gifts come in, especially if they're unrestricted and not designated for endowment. You could make choices about, do we want to set these aside for, long-term use, or how much should we set aside for long-term versus short-term? And as you build up your investment resources, it'll give you more reserve and give you more capacity year after year.
That's actually funny. So as you were talking about planned gifts, it is planned, but by somebody else. Oh, I don't know why. So for you guys, it's really unplanned gifts because you're not quite sure when they may come in, right? But if the donor, well, some donors want to inform you, some donors don't. I certainly can tell you that lawyers and tax accountants would encourage the donor to inform the charitable organization, subject to change, right? You can change a will, you can change some trusts. But that gives your organization the opportunity to kind of keep that person in the fold, is to kind of be on alert from a donor relations perspective that someday, sometime, some way, in connection with this person's estate plan, that gift will come in.
And that's a great point, because if you don't, so by having at least the structure, like to say, our board has talked about this idea of planned gifts, and that we want to ask our, the people that support us and love us to give us those, by having that structure and by putting that out there to your constituents, that can sometimes afford you the opportunity to have those discussions where you may not get to have those discussions otherwise, and that's definitely a much harder position to be in, to just be, having these planned gifts show up that you didn't have any interaction on, that may be, very difficult to integrate, especially if they were created sometime, before. They may have been created a decade or more before the person passed away, and who knows what's changed with your organization since then. There could have definitely been opportunities to engage that person on their gift and maybe, adjust their gift over time, had that opportunity been put out there. So, all right, so let's talk about why now. So, we're always seeing wealth transfer, right? People are always passing away and their resources are transitioning to the next generation. But it's been a pretty important thing because of the amount of wealth transfer that was happening from the World War II and silent generations to the baby boomers. But now we're actually starting to see that beginning from the boomers to, the generations after them.
Who's after millennial? What, who are they? Gen,
Gen Z.
we skip Gen Y and we went right to Gen Z.
I think millennials were that one.
Oh, God, okay. Thank you.
I'm a millennial.
I got it.
Silent voice, the silent voice to the
Right.
left of us is Jan Lane,
Right.
Senior
good.
Philanthropic
Gino,
Advisor at the
Gino.
Community Foundation.
That's right. I'm a Gen Xer.
Okay.
Gen Z, huh?
Yeah, so, but that boomer group is huge, and that, the amount of wealth that they have and the amount of wealth that's going to transfer is likewise, very large. And so, so that's why it's important now. And one of the things that, we did 11 years ago was we did a transfer of wealth study in central New York. We did that with a few other community foundations across upstate New York. And then we redid that actually just this year. So that report just came out at the end of June. We've been updating, our 5 for CMY website, which is informed by that transfer of wealth data. Our whole message is about, this is where you lived. This is part of who you are. Your kids may not live here anymore. And what if instead of, giving 100% of your resources to your kids, what if you only gave 95% of the resources to your kids? What if instead 5% went to the nonprofits that you care about? And that's a way to give for all of us to consider giving back to this region. When you think about that, you think about the different impacts that it can have. This is just another newly created by our communications team, Corey, who's running our Zoom today, created this infographic for us just a week or two ago. But it talks about, what are the issues here in central New York? What could your resources do for central New York? And then when you look at it sort of in the aggregate, it's big numbers. There's $25 billion expected to transfer, in our community over 10 years. But when that comes down to the per household level, it's just under $80,000 it's going to transfer in the average household. So you're really talking about, 5% of that. So if the average household gave, $4,000 of their $80,000 to nonprofits that they care about, and also the high net worth people did their 5%, that would all combine together to create $1.3 billion in resources for local nonprofits. Some of that might be here at the community foundation. Some of that, would be at the individual nonprofits. But let me, for perspective, the community foundation has about $400 million in assets as of the end of our fiscal year on March 31st. I mean, 400 million, and we're the largest non-college endowment, so we're the largest endowment for basically public use here in central New York. That is, 1.3 billion would be a game changer. That would just give us so much more resources to be able to distribute each year if those dollars came in. Even if only a part of it was to the community foundation and a lot of it went to individual charities. But
I have 2 questions.
Yep.
One is 5 for CNY. Is that a link off of the community foundation website or is it?
yeah, it sits on our webpage, but 5 for
Is it
CNY.org is, if you just go to 5 for CNY.org, they'll take you to the 5 for CNY page, which is,
Are there play giving reasons on that website?
yeah, it talks about different ways to give, tells different stories of people that have decided to leave a legacy through the 5 for CMY.
And do we
approach.
maintain, do the foundation maintain it? It's
Yes.
One of our,
Yeah, it's
I remember when, round one.
Yeah.
But yeah, wow, I mean, that's very powerful. Endowed dollars, I mean, it may be the long game. Each foundation is 95 years long. But here's an example of what endowed funds, so in 2008, right, last week, president. The assets of the Community Foundation were about $89 million. $89 million. As of March. And now they're 400 million. So it's just like what's happening inside of the boomers retirement plan. It's tax deferred, it's growing and growing and growing, and there's no capital gains. And it keeps growing and growing and growing. Of course, the boomers have to take minimum distribution for 72 now, they changed that law. So later and later, the life expectancy came out last week, and it's down because of COVID and that's really powerful stuff on endowment. But yeah, 2008, $89 million. Now it's $400 million.
Yeah, we did have a great market run between 2009 and this past year. So absolutely, that makes a huge difference for those resources that you can set aside for long term. Yeah, and I would encourage everybody to go look at 5forcny.org. It is meant to be ecumenical. It is not a community foundation, pitch. It is a place where people can learn about the idea of wealth transfer, how to support different organizations that they love. And there's videos and other information there that you can use that again, aren't just about the community foundation. They can be just used in your conversations with your constituents should you want to go do this work independently. Which we encourage you all to at least consider doing. So if you look at preparing for that wealth transfer, preparing to receive that, right now, I mean, many, I would say even most Central New York nonprofits don't have a planned giving program. They don't accept planned gifts. They don't have a legacy society. So those sound like, to many of you, it might sound like, wow, those are a lot of things to do. That's a heavy lift, so, but it can be as simple as, saying that we're going to just remind people to include us in their financial and estate plans. And that might just be a one-liner. And if somebody says, oh, how do I do that? You could connect them to the community foundation. Me or any member of my team are glad to work with your donors to help create a planned gift that supports your organization after they're gone. You have complex gifts, and we're going to talk about a fund type that allows you to use us for those kinds of gifts. You have something come up, somebody wants to leave you a piece of real estate, or they want to give you closely held stock of their corporation, or whatever the case may be. You can always reach out to us and we can help you at least know where to take next steps. Same thing with a legacy society. I mean, a legacy society effectively is just a list of the people that are planning to give, have done a planned gift for you. What you choose to do beyond that, as far as like how you recognize them and how you talk about them, can get more time intensive. But at the minimum, just having that list gives you that opportunity to make that choice about, when could we start maybe having a legacy society dinner once a year, or when could we, start sending something out, maybe a once a year letter to the legacy society, updating them on, what's happening. And so those kinds of things, by starting small, and we're going to get into that, here in a little bit, some steps you can take, at least you have the things in place to grow on. And with that, gifts will come. So, you want to talk about the millionaire next door?
Sure. So. Titled The Millionaire Next Door. Millionaire Next Door phenomenon, to me, is what you read in the newspaper. Right? Oh. Oh. Sure. Okay. The speaker.
I'm gonna
is-
turn the.
Oh, but I know what's happening. They turn out the AC just kicked on. So, okay, guys, so millionaire next door phenomenon. There's nothing really you can do about it except to be nice to your donors. Millionaire next door. Oh, thanks, Tom. Better. Can you guys hear me? Corey, Danielle? Yeah, okay.
Yeah,
So-
much better.
Yeah, well, the AC kicked on and that was drowning me out a little bit. It's the teacher with $2.5 million who lives in the house that she's lived in for 50 years and gives all of her money to the community foundation. It's the couple in Binghamton who gives Lemoyne College something like $50 million. They owned a dry cleaning business and so on and so forth. So there's not really much you guys can do as not-for-profit execs to identify them, because you never really know. They're very frugal. Don't judge a book by its cover. If you see somebody coming, it could be your next millionaire next door. What did you want to say about that?
No, I was just gonna say that's the
Yeah.
more common thing, especially
kinda
here in
fun.
central New York, and it's, when you like, yeah, just happens all the time.
Does, but there's no real way to plan. It's like the lottery winners, on Erie Boulevard at the Price Chopper or at the local. You're like, wow, that's great. But there's not any really good way to plan. But I can tell you their lawyer knew, their tax accountant knew, their financial advisor probably knew. So encouraging folks in those spheres who are connected to your organization that to establish the relationship. Now, some people in the millionaire next door phenomenon, they just don't want it. They're really undercover. They don't want anybody to know about their wealth, and that's the word. So, but you can hope. $1 in a dream.
All right, so,
This is the fun stuff.
yeah,
This is really it. This is the meat. You're like, so how do I do this? How do you make a plan gift, right?
yeah, so, there's so many different kinds of plan gifts, and they range in complexity. And so I've, listed some there, and we're gonna talk about like why a donor might choose one type of plan gift over the other, but, the most straightforward are what I put in that handout in the chat was, how to tell your donors to put something in their will or their trust, how to direct a gift from their will or their trust, that's the bequest language, or how to make your organization a designated beneficiary of either their IRA or their 401k or their life insurance, something that has a designated beneficiary. And again, it doesn't need to be all of it. The bequest might be a specific dollar amount. It might be a percentage. There's reasons why different, people choose different approaches there. Same with the IRA or the 401k or the life insurance. It could be a percentage, even 5%, 5%. And why we chose that for a reason, because that's a meaningful result if people just do 5%. So, we don't need, everybody leaving 50%. That'd be great, but the difference would be made with much less.
Let me just jump back. So some of the most straightforward, obviously, that means easier to navigate, right? That word bequest, it is a legal word. It's either the language in somebody's will that says I give X percentage or this dollar amount to your organization, or it's in a trust, sometimes revocable trusts, changeable, amendable, also known as living trusts. So it's the language in the document that bequest, right? Beneficiary designation, you all know. It's, as Tom said, IRA, 401k. Sometimes it can even be an investment account with they call it basically a TOD designation. But it's all in the planning, right? With the attorney and with the financial advisor or the tax accountant. And you guys know life insurance has a beneficiary designation. So those are very easy. Everything after that, up in the top, charitable trusts, charitable gift annuities, pooled income funds, real estate, bargain sales, those need a lot of discussion. If your organization is going to accept, say, a house, you want to know, oh boy, that's a lot. Where's the house? What kind of shape is it in? Is there going to be money that comes along with the house? Because you're going to have to insure it, pay the property taxes, at least in the beginning. So more complex, the more discussion is going to be in order. But don't get scared away. I mean, most executive directors, presidents of your not-for-profit organizations, speak this language generally. It's like high school French, high school Spanish, right? And sometimes there is a planned giving officer at an organization. Most universities have a development officer, and even more focused is a development officer who focuses on planned giving. Syracuse University has this set up, and you'll watch literally a third of every university's campaign is planned gifts. I mean, yeah, it's big bucks to create the building right now, but a third of these massive $1 billion plus campaigns that universities launch, planned gifts. So you need a general knowledge and a general understanding and a general fluency of how to make a planned gift, but don't get bogged down in the details of the complexity of the gift, because you're not expected to have all the answers. It's almost the more questions you ask about whatever the donor's intention is, the better. Not what you say at this point of the game, it's what you ask in developing the relationship. And you can find the answers, but you do need a general familiarity and fluency with at least the most basic of these mechanisms.
Yeah. And like another thing that comes up from time to time, I've definitely had donors that came to me and said, I would really like to do a charitable gift annuity. And then I'd be like, oh, help me understand, why you want to do a charitable gift annuity. And it turns out, after I asked them the questions, they don't need the income stream. They wanted to do the charitable gift annuity because their neighbor was talking about having done a charitable gift annuity for an organization that they care about. So, I mean, like, sometimes it's just not right. And that's actually for that particular donor. So even if they're the ones bringing it up, and so this is what this next slide really talks about, is aligning, the donor's needs with the gift vehicle that gets selected. So sometimes it's about what do they even have? What are the resources that they have? And back to what Christine was saying, on the previous slide, the reason why a lot of those campaign gifts are complex gifts is because that's what a lot of higher net worth people have, and that's why you don't want to be afraid to accept something like that. You just need to make sure you have the right people to connect with when those opportunities come up, so you are confident that it's being done the right way, because that could be a lot of where the people's resources are that support you now.
Let me also add that you can Google it. What can't you Google these days? But a lot of the more complicated, complex organizations have what they call a gift acceptance policy. And that is really, this is how we deal with gifts of real estate. This is how we deal with gifts of, I don't know, artwork. This is how we deal with gifts of business interests, right? LLC interests or shares of stock. So it kind of is a roadmap for some of the more complicated organizations as to what a donor and the donor's professional advisors are going to need to do or navigate if they want to give something basically isn't cash.
Yeah, and that gift acceptance policy is a great gift to future board and future staff in your organization. So if you know, this is how we do, these things for this bucket of stuff that might be other gifts, we refer that out, or, we go see a third party, or, whatever the case may be, that guidance and sharing that in a policy is very useful as, staff and board change over time too. So yeah, the other piece on this I just want to highlight is, sometimes donors are looking for a tax deduction. Christine talked about that, might be income tax, might be estate tax. Sometimes they're looking for an income stream, that, and there's definitely different charitable, planned charitable gifts that can provide that for them. They may not have a pension, but they know they want to, leave part of their estate to your organization. So a charitable remainder trust might be a good way to do that, where the remainder goes to your organization, but during their lifetime, they get a payout, every year from that trust, so that they have that reliable income.
Yeah. Tom, you know what I'm thinking? I'm thinking after this slide, we sort of take a turn.
Towards,
Let me just sort of bang this out. Let me just
Yeah.
speak in detail, but relatively quickly, if that's okay.
yeah, and we'll
About
actually take a
these
break after this.
Okay, that's a good idea. That's a good idea. It's 10 after 10. Okay, so let's look on the left-hand column, asset-based gifts. Okay. Retirement plans. So my goal here with this slide is to explain what you see as written and pull in lots of things that we've already mentioned in the last hour plus. So asset-based gifts, retirement plans. What kind of retirement plans? IRAs, 401ks, 403bs, any kind of tax deferred, employer sponsored retirement plan. We also talked about the fact that there's a beneficiary designation. So there's a form that the donor, the owner, has to fill out, and they have to designate who are their intended beneficiaries. Where's this money gonna go? 50% to the community foundation, and the other 50% to my grandchildren or children who don't come visit me anymore. So there's a form, right? And a lot of times that form is online, but the older folks, some can figure it out, like at TIA is where a lot of tech savvy, usually university professors can figure out how to do it online. If not, there's a form, okay? Charitable IRA rollover. So what I think about that is, so it is, well, I could be at any age. Well, so it says F reenacted. Is that the QCD? Is that what we're
Yeah,
talking about?
I should actually delete that. That's
Okay.
old. But yeah, the QCD is now,
that's-
if you're 70 and a half or older, you can give up to $100,000 to your favorite charities, and it counts towards your RMD if you're old enough to have RMDs.
Right. So when you get to be a certain age, 70 plus, you have to take money out of your retirement plan. But sometimes you're like, oh my God, I don't, if you're fortunate enough to not to actually need that money. You can tell whoever the custodian is, give it to this not-for-profit organization directly. It's up to 100,000. They made it permanent, sort of a test run in the last few years, but they did make it permanent. What I think is you can make a charity the beneficiary of 100% of your retirement account if you want to. Life insurance. Everybody understands life insurance. And for small premiums today, or maybe the policies get paid up, your beneficiary could be hundreds of thousands of dollars that you don't have, and everyone will pass away eventually, you could name a charity the beneficiary of life insurance. These are easy. Real estate. So you're gonna need a big discussion about this, and you're gonna need a lawyer. Some donors want to give their house. Well, okay, great. Well, is it expensive? Is it in great shape, not great shape, good area? What's the prospects for growth? There's a lot of stuff you have to figure out to receive real estate. What is mentioned here is sometimes people, maybe the millionaires next door, they say, well, I'll give you my house, but I want to live here until I can no longer live independently in my home or for my life. That's a legal thing called a life estate. It's a manner of owning real estate. That's why you're going to need a lawyer. There's lots of conversations about real estate. Likewise, securities. Right now, every day, donors are giving securities. Usually, they're giving securities that if they sold it today, well, maybe today is not a good example, everything's down. But in other years, low cost basis securities. So if you have stock that's valued at $100 a share right now, and you bought it at 10, and you really don't want it anymore, but you'd like the income tax benefits, there are ways to transfer that stock along with its embedded tax to a charitable organization. Now you're going to need a financial advisor to get that one off the block. But so, okay, those are asset-based gifts. Gift vehicles or strategies. Again, we started here in our little cartoon said, it's all, a lot of times it's all about the income tax situation or the estate tax situation. Sometimes donors are willing to give money to a charitable organization, but they want the benefit of the asset during the life, whether it's living in their house or an income stream. Charitable gift annuities, it's a product actually. And you guys really, you have to be in existence. There is an actuarial, it's regulated by the New York State Insurance Department. You have to be in existence at least 10 years and actuarially carry like X millions of dollars to be able to even offer those. Usually you work with a vendor.
In fact, we use a vendor here. Like we we can provide them directly, and we definitely have charitable gift annuities that we are the creator of here still. But about a year or two ago, we decided to start using the National Gift Annuity Foundation because they became licensed in New York, and they do a very good job, and it makes it very easy, and it's pretty transparent to the donor, you know, and basically you don't have to do any work except for help the donor fill out the forms, and then you receive the donor receives the payments from the gift annuity from the National Gift Annuity Foundation, and then you receive the proceeds from the gift annuity when the donor passes away.
Those are marketed quite heavily by colleges and universities because it's easy to understand, right? The donor gives $100,000. There's this intermediary organization like the National Gift Annuity Foundation, which is really acting like an insurance company. That's why there's all these actuarial calculations. They got all these lives. How much money do they have to hang on to be able to make those payments? So in any event, that's heavily marketed, but usually you work with a vendor. Charitable remainder trust. So this is like big time legal stuff. The charitable remainder trust is actually a trust document, right? There's a trustee, well, there's a creator of the trust, there's a trustee, sometimes they're the same people. They're putting money in, they have an income interest, maybe for one life or two, them and their spouse. They're investing the money with their financial advisor. And then there are certain provisions for the charities, usually on the conclusion of the lives, right? And sometimes they terminate charitable trusts and you get lucky as a not-for-profit organization and you get the money. But the trust is complicated. The calculations of how much can you put in is calculated. It's complicated. The investments are complicated. The tax return but the charitable major trust is complicated. And so you're really gonna need some help with that, but it's out there. The easier go-to is the charitable gift annuity. And then we talked about bequests. Now you're really gonna need that language, and Tom has provided a form that you can give to your donors and their professional advisors, but
But again, that's like super basic too,
Yeah.
like the bequests can get complex if, you know, if the donor intends them to be. So again, it just all goes back to the donor. So at this point, let's take a 5-minute bio break and we'll come back at I guess 10:22.
nice.
And as you move in and out of the session, please don't forget to send in the chat any future topics you'd like to see. Thank you.
I'm gonna just stop our. Um, as promised, it's 10:22, so let's resume and take this to the end. We've got probably the fun stuff coming up because, you know, we sort of got the fundamentals out of the way in the beginning here. Before we move forward, are there any questions, Corey or Danielle, that we should be addressing at this point?
I think we collected a few from the beginning, but I think we missed one earlier when we opened it for questions. And that question was, if more than one endowment were created on our behalf, is it ever possible to combine them to increase potential returns?
So, so at the community foundation, so say 2 donors, you know, loved the same organization, and we worked with them to learn their story and create a fund that they named and did what they wanted. Just because they support the same organization, which happens a lot, we don't combine those. And there's also no benefits to the investment part to combine those because they still both sit in our main investment pool. So they're getting the same gains and losses over time, the same potential for growth and all of that. There's no change in the fees or anything like that. So they're basically, whether they were combined or separated, it doesn't matter performance wise. You know, if you were doing it for your own nonprofit and you had a pool, you could, you know, you could do the same thing. You could have the gift from one person, the gift from another, and you could put those in the same pool. You would just do the same thing we do and do the pro rata share of those gifts if you wanted to keep them separate. So you could say, this is the gift from this person and this is the gift from that person. So you can continue to tell their story, which is why we keep them separate, because we want everybody to be remembered, you know, and have their story told as well. So I think that, you know, there may be cases where you do want to pool the assets together for management and there's benefits there, but
So I think about it like this. When an endowment comes in, you either have, remember, that's the magic word, right? Endowment. There, you're like on alert. Oh my God, it's an endowment. I have to keep X amount. You are bound by the donor's intention and some kind of gift instrument. So whether it's a contract, whether it's language in a will, language in a trust, you can't really deviate from that, even if the purposes are kind of general. You actually, and then remember the part when I was referring that sometimes this might be one of those, you get stuck with an endowment fund. Either it says endowed fund, but they only gave us $15,000. That's impossible. Or it's been around for decades and nobody really can find the documents and they don't know what to do. There are rules for legal rules for how you handle that endowment. Like if an endowed fund is over 20 years old and it's less than 100 grand, there are rules in the law that direct how the board can make decisions about it. So this could be an example of that. But, and then if you've lost the documentation, if it was in a will, you can get a copy because the will, probate records, court records are public records. So there's ways to figure it out. So, and there are things that you can do with an endowment fund. So the combining part. So I'm saying that each endowed fund has a plan, a donor, and a legal document behind it, right? Different from, I have 3 endowments, one is 100,000, one is 50,000, and the second is 25,000. You can take all of that 175,000 and just invest it in your portfolio. So it's the difference between keeping track for the accountants and in your QuickBooks or Quicken of the endowment fund and investing the money in the aggregate. Everybody invests the money in the aggregate pretty much. The other thing is auditors. So if you hit the level of having a review or needing an audit for your organization, those CPAs are going to want to see the detail of the endowment funds because they're going to code it one of 2 ways. Oh, this is restricted. This is unrestricted. There used to be this classification called temporarily restricted, but now it kind of goes in.
Yeah, it's either donor restricted or.
Yeah, right. So I guess the endowment, you got to pay attention. There's lots of rules about how to navigate them. But there's a legal document. You always pretty much are aggregating the investments. So it's really a bookkeeping and accounting thing. But organizations get stuck with some crazy endowment that doesn't have enough money to be an endowment.
Yeah, and you just get to go to court and figure that out.
Right. Sometimes you have to go to court as part of the figuring it out.
Any other questions, Corey, or was that the only one?
No, I think we had some quite a few questions about engaging boards at organizations. But I'm not sure if that's part of your presentation coming up or not. So
Yeah, we'll get to that.
Yep.
Yeah.
All right, great. So I want to just take a quick second and remind you about the tax aspects. This is a very simple example. So if someone has $100,000 in an IRA and $100,000 in cash, and they want to leave half of their money to charity and half of it to an heir, it matters which one they choose to go to the charity. So in the case where you give the charity the cash and you give the IRA to the heir, that's the left-hand column, the heir gets taxed on the IRA. And that 100,000 becomes something more like 65,000 or even less, depending on what their tax bracket is and how they take it out. The second column shows if they give the IRA to charity and the cash to the heir, both get $100,000 because the IRA is not taxable to the charity because the charity is tax exempt. So all of that tax that is, buried in there, tax due that's buried in there, goes away. So just a simple example of why you need to involve advisors. So
We're good for something.
exactly. So this is another slide that I didn't mention this before, but when you look at the investments, like you put an endowment, you invest it, it's in the market, that orange line shows what might happen with the market over time. But the cumulative spending line is pretty stable and growing. And the reason for that is because one thing we do in addition to figuring out that spending rate is we actually do a 20-quarter rolling average balance of the fund when we choose or when we apply that 4.4% rate to it. So we actually use a 5-year average balance of the fund in order to determine how much to spend. So what that does is it prevents us overspending in good years when the market is up or underspending in bad years when the market is down. So instead of using just a snapshot of the fund, we use that 20-quarter rolling average. And then that is a way that it kind of makes that spending even more stable and contributes to the sustainability. So,
It smooths it out. Can you imagine if our community foundation grants budget was based on what happened in the first quarter, even the second quarter of this year? Be terrible.
right.
So that's a long time, 5 years of an average. Some organizations use 3. But it sort of smooths out the jagged red line of investment.
So we talked a number of times about a designated fund. A donor might come to the community foundation and say, I want to support these 3 or 4 organizations or this one organization, whatever it is, you know, and they create it. And so that spendable amount goes out each year. And that is, you know, definitely a way a donor can do an endowment for your organization. So another way you could do a fund at the community foundation for your organization is called an agency fund. And that's where you as a nonprofit create a fund for yourselves. You basically become a donor to the community foundation. And it's different than any of the other funds we have at the community foundation because it's created by a nonprofit solely for your own benefit as a nonprofit. It actually remains an asset on your books. And you can typically take the up to 100% of the assets back from the fund if you needed them. So we apply the same sort of investment approach to it. So it's designed for long-term funds to be in there. We share with you each year what we recommend you spend if you were going to treat it as an endowment or permanently. But you can basically put, you know, unrestricted assets. You can choose what of those you want, you know, to take off of, you know, your out of your cash reserves and move them over, you know, what you decide as what is long-term and what has potential to grow and benefit you in this way as an organization. And it can, so this is another tool, and that agency fund is there for donors to give to as well, both during their lifetime and as part of their financial and estate plans. You know, it's just intended only for unrestricted assets. It's not really there for anything that's required to be endowed or required for a particular, you know, purpose. Those need to be segregated differently. And so, but the agency fund is sort of that most flexible, sustainable tool that you might want to create as an organization. And whether you're doing an agency fund or you're setting up an investment and setting aside dollars on your own for long-term management, you know, one of the things I try to encourage nonprofits to do is have a goal and also make rules for what goes into that long-term growth space. And by endowment, in this case, it really means quasi-endowment. It means you're treating it like an endowment. Because a future board might decide that they want the dollars back and need to spend it on a new building or something like that. But it's a way to sort of segregate some unrestricted dollars for sort of longer term use.
So before we change on this slide.
Yep.
So to me, this goes in the category of how can the community foundation help your not-for-profit organization with its mission? Many times these assets are, you know, we've talked an awful lot about donor restricted, donor intentions, donor wishes. Oftentimes these could be board restricted. Maybe you get you get $100,000 in a will, and you're fortunate enough to have it be just unrestricted. Your board can decide, whoa, this is like a gift from God. Let's park this for a rainy day. Let's invest it. Let's not spend it. But oh my God, our organization isn't set up for this. We don't know who to use to invest $100 grand. We don't know when we're going to need the money again. We don't know. This is where your organization partnering with the community foundation to help you with this money, creating an agency fund, handing the money over. You can get the money back. So it's an asset on your organization's books. On the community foundation end of things, it's an asset, but it's also a liability. So it washes out, right? You can't double count it in accounting.
Right.
And that is a way that the community foundation can help your organization. If you don't know what in the world to do with this money, how to invest it, who do I, do I call somebody, Morgan Stanley that I know, or Merrill Lynch, or what do we put it, Vanguard, Schwab? I hear those are low cost providers. If you don't know what to do with any of that, or even if you need help in figuring out what to do with any of that, you can call the community foundation, and 9 times out of 10, it will be an agency fund that you're looking for. And the community foundation does charge a fee, just like Vanguard charges investment fees and investment management. But you get 2 things. You get the help of the community foundation advisors. You're fulfilling your fiduciary duty because you're doing it properly. It counts as an asset of yours. If you need the money back, your board can so decide, and the community foundation will work with you. And you may like that experience so much that the next time you get a gift, you park it in the community foundation's, the agency fund for your organization. And it doesn't have to just be small dollars. I mean, organizations have created agency funds with 500, 700, millions of dollars. So that's where the community foundation is here to help you, just like with what we're doing today, trying to provide some education and guidance about this.
And again, we start those as low as 10,000. And, so it doesn't matter to us if it's a 10,000 or 10 million, we'll start them wherever you're at and whatever you need, so even if it's a relatively small amount that you're ready to set aside for long-term use. And, every time you do that, you can hear in the distance, future staff and board members thanking you for setting aside long-term dollars, so.
And the big thing is you're doing it the right way, and you're fulfilling your fiduciary duty, and you're not going to go get yourself in trouble with the attorney general or your auditors, because it'll be done right way. So it relieves you of that liability and responsibility while retaining all the benefits.
All right, so, whoops, cannot seem to click one
I
slide.
think we're on 12.
What's going on here? All right.
Are we? Yeah, I'm good. Are we, how we do Thanksgiving?
I don't know why it's not letting, there we go. Okay. It was getting trigger happy there. All right, so, when you,
Ah.
yeah,
I didn't even turn the page.
yeah. So one of my favorite quotes of all time is that hope is not a strategy. And so, I just wanted to put that out there. So we're going to get into the how-to now. So, and really when you start thinking about how do you talk about plan giving with your own staff and with your board, it really comes down to some fundamentals, so what is the purpose of this? Why are you doing this? What is your goal for this? And then, who's going to be responsible? And those sort of things you really need to think about. And, depending on the answers, that will depend on how much capacity you need to devote to this. So if the purpose of this is just very straightforward, we want to let donors know that plan giving is an option. What is the goal? The goal is, to communicate, this option to our donors, and who's responsible, the person that writes the newsletter, so it could be very, very straightforward like that. Or it could be much more, intense than that and require, more effort through multiple departments. Anything you wanted to add there before we talked a little bit about these things, some of these things before, but once you start deciding to do plan gifts, your board members might say, well, don't we need a gift acceptance policy? And that's probably yes. It just depends on exactly what you're going to be doing there, what the answers to those 3 sort of planning questions were. But again, it's not necessarily a yes. So,
And it doesn't have to be super complicated. You can start with sort of a bare bones, like baby gift acceptance policy. You don't have to even get into exquisite detail, like some of the more complicated things on that slide where we're looking at charitable trusts and charitable gift annuities. You don't have to build that now. And though that the templates for those policies, like at the Plan Giving Design Center, and you can even hobble off of colleges, universities have.
And we'll share ours with
Yeah,
you.
oh,
We'll
that's
share
good.
other ones that we have. So I mean.
Yeah,
like,
I mean, it's
absolutely.
not, you don't have to worry.
Yeah, don't reinvent the wheel there for
Yeah.
sure.
Don't.
But then you're gonna have some choices to make, if you're gonna start asking for gifts, what are you gonna do with them? Because that's important. You need to tell the donors that. But also you have some opportunities, so like what if, your annual event, really exceeds expectations? You could make a choice to set those dollars aside for long-term growth. What if a capital campaign, same thing, what if it exceeds, the goal? You could have set some of that remainder off for long-term, use. What if your cash reserves have been building, and you don't need that much in cash reserves anymore? What choices can you make there to set some of those dollars aside? Then there's other opportunities that come up when you have this place that you can put long-term dollars. What if you have sort of these opportunities around, you have somebody important to your organization retiring? You could do some fundraising around that. What if you reach your 50th anniversary as an organization or your 10th? You could, make some, have some opportunities for donating to the long-term sustainability of the organization as well. These are sort of places where extra dollars might be meaningful to donors, that they may want to say, oh yeah, I want to give to that. And it's beyond what they normally do. All right, so when you think about things like marketing, this isn't where you start. I can't tell you how many different organizations, when they start talking about plan giving with us, say, well, do you have a brochure that we could hand out to people? And I'm like, well, you may want to develop that down the road, but that's not necessarily where you want to start. You want to make decisions about, that, and what collateral you create sort of comes off of, what exactly you choose to do. But like we talked about with the basic gift types, planned gift types, that's where you start. You want to start by, asking people, have they already included you in their will? Have they already made you a beneficiary of their estate, of their retirement plan? Are you already designated there? By asking, you might get some people to raise their hands. And if that is the case, you should ask them for their story. You should ask them why they did that, focus on the mission and the impact that's important to them. And the reason that you ask them for your story is because then you're going to ask them, do you mind if we share your story so that we can inspire other people to do the same thing? And then it's really the story sharing, and definitely not a brochure sharing, that sort of helps it propagate.
When I think about marketing, and to one of the questions in the chat from earlier about how do I engage my board? How do I do this? For me, it's all about relationships, right? And is your organization leaving opportunities on the table, off the table? I forget what the expression is, but is in the relationships that your organization has, whether it's with your board, whether it's your current donors, you can identify who your largest and most involved donors already are. If you don't start to have that conversation about plan giving, you're really leaving something off. You're leaving something out, right? It's not on the table. You want it to be on the table. It's something that your donors should do. Annual gifts are great. Annual gifts of stock, annual gifts of cash, the whole thing. But you really are leaving something off the table if you don't also mention to those people who already have connected relationships with your organization. It's easy to continue that conversation. And for the most part, plan giving can be very easy and it's painless, right? Because nobody thinks, 5, 10 years into the future necessarily. They don't think, oh, well, when I pass away, this is gonna go. It's painless. It makes your donors feel great now. They get the benefit of feeling great, some kind of either income or estate tax benefit. And they feel like, well, it'll be a nice legacy and it's a nice purpose that I've designed for this gift. So engaging your board in this conversation, in extending relationships, both people who are already connected to your organization and then with your board members who they know, who comes to the events, who they know, ask them about the mission of the organization. Starting those conversations, weaving it in. It doesn't have to be complicated. It can be very simple. Starting those conversations.
Totally. Mentioning versus marketing.
Yeah.
So, and once you start talking about it, and once you have people that start saying that they're gonna do that or that they have done that, just keep track of that, create, we call it a legacy society, other places call it different things. But, whatever that,
We're in a tree of life.
the tree of life,
Sometimes there's trees on the wall and each particular donor has a leaf.
mhm. And in the membership in that, we highly encourage it to be inclusive and meaningful. So what that means is basically, it shouldn't matter what the size of the gift is. And in fact, I would actually encourage you to not even worry about what the size of the gift is. If someone says, I made you a beneficiary of my IRA, you say thank you. And they may want to tell you how much that is. But the fact of the matter is they don't even know what that really is. They don't know what the balance of their IRA is going to be the day they die. They could maybe give you an estimate now of what it is, based on and what that percentage is. But it shouldn't be the important thing in the discussion. It shouldn't be the thing that they think you care about the most. What you care about is that you decided to include the organization that you both love in their financial plan. I would encourage you not to ask for documentation. Can I have a copy of your beneficiary designation form?
Right.
That's a little like, we don't do that,
Or a copy of your will. People, that's private,
right.
right? I could change it.
You'll get- right.
Change the provision for my kids or grandkids, yeah.
And that's another thing too, like everything that we do on the legacy front is non-binding. We would never want to have to go after an estate, because somebody changed their mind about what they were going to leave to the community foundation. So everything we do is non-binding, except in like cases like charitable remainder trusts where it's actually set in stone right when it's created. Recognize that list. It's probably just as important to recognize them, like you do, annual givers or campaign givers or event sponsors or things like that. Maybe it just goes on the website someplace. Maybe it goes in the annual report. Make sure you're inviting them to things. Maybe even have a special event for them. Feature their stories in different places, because that again is going to be where you get more people to do this. So who are these people? Who are these people that we should be
Who are your
getting
targets,
requests from?
prospects?
Right? And it's the people that, are close to your organization. It's your best friends. So these are some examples of, the people that might fall into that category. And, volunteers, is like the fifth bullet down. And it's, that's actually a place where you might find some millionaire next doors as well. Maybe they didn't have resources to give you during their life. Maybe they just had their time, but there could be a big gift that comes from them as well. But these are all different categories. And so what I'd like to do now is just to take a couple of minutes, and instead of going into breakout rooms for this, if back when we did this in person, I would have you get into small groups and talk about this, and create the numbers for your own organization, but just for these categories right here, just put down rough numbers of how many board members do you have right now? Maybe how many former board members do you have that are still alive? How many longtime donors do you think you have? How many major donors do you think you have? How many people that are emotionally attached, close volunteers, things like that, and others that come to mind. So I just want you to tally those up. And when you get your tally done, I'm sorry I'm making you do math, but if you can put that tally into the chat, just so that we can actually see from different organizations what those numbers look like. And maybe Corey, as you start seeing those, and we get some in there, maybe just read a few of those off so that we can sort of maybe inspire each other, because I'm thinking that number might be higher than you think it is. So we'll just take a minute to do that.
So this far, or thus far, we have around 200 and approximately 500.
Wow, that's great. A lot of conversation, a lot of lunches, coffees, dinners,
A lot of opportunities.
a lot of opportunity.
Yeah, so that definitely makes the point right there. And I don't know what the size of those organizations are, but even smaller organizations, you're gonna have dozens, dozens of people. Even younger, smaller organizations, you're still gonna have, dozens of people to be able to talk about this with. And that really leads us into sort of, how do you work this into your development process? Christine, I don't know if you want to talk about the average age of people that come to you to talk about their
Yeah.
final estate plans, but it's retirement age-ish.
It's kind of funny. People come to this trust and estates attorneys usually, well, at all times, and usually revisit their estate plan every 5, 6, maybe sometimes 7 years. So people come to an attorney when they've had children, right? They acquire life insurance. They say if disaster happens, I need liquidity here for these kids and for my spouse. I need to name a guardian who's going to take care of my kids if something happens to me. So they usually come at that time. And they oftentimes have certain provisions for their kids. As your children get older, and certainly when they graduate from high school and college, you know what your kid, if you have kids, is all about, right? Are they good with money? Are they a spendthrift? You're in your working years, you're hopefully deferring the max. So that's when you're in your 50s, late 40s, 50s, people come to the trust and estates attorney, and most commonly, sometimes they start having to take care of their parents, right? So the sandwich generation, they're taking care of their kids, they're taking care of their parents, and they think, and they see all this stuff that their parents did or didn't do. And while they're still working and still acquiring, accumulating assets and taking care of trying to educate these children, or they're looking and thinking about their pension benefits, they come back to the trust and estates attorney. And then that pre-retirement planning process, to your point, Tom, we will start to think about it. They've identified, what others are doing in their particular field. What's their Social Security max retirement age to get 100%? Do they have a pension? Not really. Do they have what in their retirement accounts? What am I going to do? How am I going to plan? And the big twist at that point are two things. Number Number one is health care issues, if there are medical issues and they're worried about long-term care. And the second thing is many of those folks at that point in time anticipate inheritance. So this is like the life cycle of a trusted estates attorney, and any day, at any given time, any number one of these kinds of things can come up from current and prospective and soon to be new clients, right? So where it makes a difference to charitable organizations really is if your person has already retired, they've already made the financial decisions in their life, they may or may not have children. If they don't have children, commonly, or a spouse, right? Sometimes there's a spouse and they want to provide for the spouse, but you would think, oh, siblings, oh, nieces and nephews. Well, that's the opportunity, because the nieces and nephews don't visit so much. And then the older people get very mad that the nieces and nephews don't visit so much and that they don't have children. And they start to change their estate planning documents, their legal documents, to think about charities at that point, because they can't take it with you. They can't take it with them. They're not going to benefit nieces and nephews necessarily. So
But the earlier you can get into somebody's will, the earlier that your organization has been identified by them as a beneficiary of something, the more likely it is going to probably stay in there. And, it's not to say that, if that they wouldn't put you in once they're in their retirement years and in, doing their final will work. That's definitely a possibility, but basically, you don't want to ignore really any of the age groups. You probably just do want to segment them a bit so that you can kind of talk with them differently about what might be important to them at the different ages, and how they might deploy. For some of them, especially people with young kids, it's going to be
different conversation.
different conversation, right? So
And I would say also, we're not saying go target the 70 and 80-year-olds, right? Because you kind of got to be careful.
Yeah.
This is the topic. Tom and I have done other presentations where we talk about some of this stuff like
ethics.
yes, planning ethics and what happens if things are challenged, meaning the kids think that their parent is off their rocker and didn't really mean that and was influenced to make a charitable gift. You got to be careful. Capacity issues, age, you got to be careful. You need certain protections, and that whole thing is the subject of a different presentation.
Yeah.
But I would say like nationally, I'm sure most bequests come from donors who are over 80. Yes, I do have 80-year-olds coming, changing documents, especially if they're savvy and with the program and financially astute, but this is probably true.
It's just, it's rare that they change their documents at that point. So,
Well, they kind of have the plan in place, right?
so when you start thinking about how do you ask for them, the best place to start is with the people that probably won't say no, the absolute best friends of your organization, the people that, love your organization. And it starts with one-on-one conversations, and we're going to get into a little role play here in a second there, but basically it starts with asking them about their story and their connection to the organization, talking about the fact that there's this new opportunity, and that can be as simple as just saying, one of the things that we haven't focused on in the past, but are doing so now, is the idea of planned gifts and having people include us in their financial and estate plans. Is that something you'd like to learn more about? And so that it can be as simple, in that one-on-one conversation, is learning about them and what's important about them, and then connecting that to this other opportunity that you hadn't brought up before. And once you have people that say yes to that, you help them get that gift done. You basically point them to their advisors, or you contact the community foundation or whoever your resource is for doing that work. And then ask them if you can share their story. And then you keep doing that. You keep that simple routine, but continuous routine. And the more stories you share, the more times you say, have you remembered to include us in your financial or estate plan, the more gifts like this happen. Did you want to add anything there before we? So donor visits. So Christine already alluded to this a little bit, age matters, but regardless of age, you absolutely always want to be respectful of time, and be clear about
be
purpose.
clear, because the other thing that maybe some of you guys have experienced is some older folks, well, let me just be frank, they got a lot of time. And so you're gonna have to drive this conversation. Some of them want to go visit their lawyer just because it's a social visit. So you got to be tight with this and stay on task.
And it's typically, especially like, not something you necessarily just want to add on to sort of your regular stewardship or your annual campaign outreach, this is something you want to just set aside as a different thing. Tell them why you're doing it, find a time that works, define what that time period is, have the questions answered, ready to go about why your organization is doing this, that back to that, what's the purpose, what's the goal, who's working on it. When you are having that visit, you need to have a goal for yourself for that visit. Is this simply just to learn more about them and assess their interests? Or are you, really digging in a little deeper and seeing if they have their final estate plan in place? Are you making an ask here? Are you actually going to bring up the idea of doing this? Once you're there, it's all about them. It's listening, being respectful, sticking to the plan time, thanking them for their time, being clear about whatever next steps there are based on what the goal was and what was achieved in the meeting. And then when you're done, it's about documentation, sending a thank you note, all the same things that you do for annual giving. It's just, definitely applicable for the planned giving interactions as well, and scheduling next steps.
And it's fine if they want to invite their spouse, invite their lawyer, invite their accountant, sort of the more the merrier, the more touches you can have in talking about this plan, the more ears you can have listening on the donor. That's just fine.
All right. So one of the things that when we're in person, we like to do, is talk through some discussion questions. This is not as easily done here, in the Zoom room, but I would encourage, you to think about these questions, and you'll get all these slides post-event. Think about, if you've done this before, how did it go? What are the areas that you can improve on? What are the things that went well? If you're just going to start doing this work, think back to those things about, what is the plan for that? And then what stumbling blocks do you see in asking for plan gifts? And those could be things that you talk about, with your board. Those are things you could talk about as, as a staff team. Those are things you could call, Jan and Pragya and Tom at the Community Foundation and just say, hey, we attended this news session and we're thinking about this, but we see the stumbling block, how do we deal with that? And we can, definitely help walk through, that with you and think about that with you. If you have, professional advisor for your organization, they could be the same sort of sounding board, your attorney or your accountant might be the place to go there. So, but right now I'd like to role play a little bit. And the idea of role play is really important. And I just want to sort of talk about that for a second before we do a breakout. So when an organization that has an agency fund with us, they actually have multiple agency funds with us for a variety of reasons, but when they wanted to go start talking about playing gifts, they got a group of their board together that wanted to work on that. And then I actually came and did role playing with them. We created scripts. We role played an interaction. You know, I was their donor that they were going to interact with, and it gave them the opportunity to practice that and learn how that would feel and learn about how those questions would come back, you know, how the donor might respond, and it allowed me to give them some feedback on maybe some words they should or shouldn't say, when talking about talking in the script. We gave them the opportunity to become more authentic with the words as well. So I would highly encourage that, both for plan giving, but for really anytime you're interacting with donors. I think it's important that, the staff or participatory board members, role play that together and actually spend time practicing that interaction, especially if it's new. So for right now, what we're going to do is we're going to send you off into breakout rooms. So I'm going to stop my share for a second. But before I do that, the questions are that you're going to ask each other is just simply, why did you first become involved with blank? Either the charity that you are representing here today, or you can name another charity, that you care about, and just simply have the one person ask, why did you first become involved with blank, and what's important to that organization to you? And then switch. And so in the breakout, we'll do that and give each of you a few minutes together to answer that question. So you'll be in random pairs. Stop my sharing here for a second. And switch. So it's going to tell me down at the bottom how many I can. All right, so I think I'm gonna you end up not being in there. So there may be some rooms that have 3 participants, but it's not. Actually, I think it doesn't include the co-host. Yeah, we'll just do this. So we're going to create the room. So you're going to be sent off into the wormhole to your breakout room. And remember, the 2 questions are just simply, how did you first become involved with this organization that you care about? And then what's important to you about that organization? And then switch. And we'll give you about all right. So we'll give you about 8 minutes to do that. So I'll just.
It looks like there's still some people besides us who aren't assigned to a room.
Yeah, so they haven't accepted the invite, so I'm moving people who haven't accepted or were in their room by themselves into a room with someone, so.
Gotcha. Thanks.
Thanks, Corey. So I'll just
Okay,
briefly do
sounds
that, but
good.
then if you want to hit the questions
Okay,
and special situations. And then we'll do final thoughts.
sounds great. Awesome. You're right, right around 11:30. It's sunny, but a little bit fun, but,
Okay.
you know, I've never asked you, what was your experience or exposure with the community center? Was it as a financial advisor?
Yeah, so my first experience was I mean, I'd come to CE seminar and so hopefully people will be flooding back here as the rooms are closing.
Eleven participants, that,
We were at
Have a-
34.
They have about 10 seconds left before they'll auto close.
okay.
Yeah, just because I pressed the close button, it still gives them like another 60 seconds.
Got it. I've been on the, and you know, I've never been, I've been a host, but not in this kind of. Been in the chat room.
So it's nice when people come back from the breakout rooms to see some smiles. You know, I hope that that role play you found to be enjoyable. If we had more time for discussion, you know, we could, and especially if we were all in the room together, we could talk about how that felt and what you observed as you just had that relatively straightforward conversation with possibly a stranger about, you know, what's important to you about an organization. And that's the kind of feeling that you will engender when you ask those questions of a donor, when you give them that opportunity to share what's important to them, when you give them that opportunity to remember their story and connect with it again. You know, it's a gift to let people think about what's important to them and to remember those kinds of moments of, you know, where their connection started and why they're still connected. So again, there's value in practicing, you know, there's value to those relationships and just doing that. I'm going to go ahead and just go back to the slides for just a couple more and we're almost done. And so there's some other questions you can talk about, or, you know, what do you hope that your organization looks like in 10, 20, 50 years from now? We won't have time for a separate role play there. But what we're going to head into now is, if I can, there we go. Questions donors may ask, so.
Sure, so. You know, usually in your first conversations, it's a sort of a mutual get to know each other, but. You know, we had populated this slide. Just so you can start thinking about maybe what the next meeting might look like, or what the meeting with. Your donor and their financial planner or attorney might look like, you know, certainly. You, by now, in our day together, you guys can answer these questions, right? How will my gift be used? Okay, well, that depends on what our donor's intention is. And what kind of a gift it is. And what does your donor want the gift to be used? And then you can talk about some of your financial policies. And how you operate and how you manage these types of gifts. One question, who, you know, that's an astute donor, right? Who manages your endowment? Meaning, where do you invest your assets? Who is helping your organization with that? Are you doing it on your own? with, you know, the executive director's neighbor who happens to be a financial guy? Or are you working with the community foundation and have an agency fund and, or create some kind of endowed fund for the community foundation? Or are you a bigger organization and actually have a consultant like Crucial Partners, who the community foundation and other endowed funds here locally use? So here's a good one. How do I know you will do what I intend? Well, there's certain protections in the law for that. The Attorney General, number one. First of all, your organization is legally bound by that donor restriction. And just like we talked about with things that happen or you want to do with endowment funds, if you want to deviate what the intentions are, or your donor didn't really consult and then and it's so narrowly construed, or you don't do that work anymore, there are ways that you can deviate the intention. But I think the intent here on number 3 on this list really is, you know, who's going to watch over you so that I know that you're going to do what you need to do. You can talk about the duties of the board. You can talk about the audit. You can talk about the Attorney General, whatever you need to say.
Or just your process as well for like, how do you document the intention and how do your staff know to pay attention to that?
Right, internal processes. What's your goal for the endowment? Obviously, growth, usually the goal, but you may you'd be asked to talk more about investments, or you might want to bring somebody who has more of an ear, maybe the chair of your finance committee, or
it may be a specific number. You may be like, we
Yeah.
really want to get to $5 million in the endowment so that we don't, you know, have to worry about, you know, this, that, and the other thing that's in the budget each year.
exactly.
I would also say, should I talk to my advisor? And I'll answer this one for you, Christine. The answer is yes. Always to that question. They should always talk to their advisor.
Always.
And then, do I have to use my name or do I get to use my name? You're going to have people that ask both sides of that, you know, and you want to be able to help make them feel confident that you're going to either treat them anonymously if that is what they prefer. And, or, you're going to also, handle the publicity well, if that's what they prefer, to have their name out there. So.
I don't know if we touched on who else is given this way. That's where your stories come in.
Yeah.
In your literature and your marketing materials and your stories about the fantastic millionaire next door that drops 2 million on your organization.
And what's also super important is to be able to say, yeah, by the way, 4 of our board members currently have done this, and about half of our former board have done this. I mean, like, to be able to say about the board, and whatever the numbers are, 1 of our board members has done this already. We're just starting out, but whatever the case may be, to be able to show that there's leadership commitment as well is an important piece. So I would always encourage you to find at least 1 board member to do this with you. So the special situations, I don't know.
It's been a thread through everything we've talked about today, right? Complex gift plans involving multiple charities. We talked not extensively, but a good deal about navigating issues with real estate, navigating issues with endowment.
If you had an endowment before and invaded it, or a lot, or it's gone now, and
Or its
people that
performance tanked.
right, and then like the people that worked, remember that, they may be like, what are you doing differently now so that doesn't happen again? So I mean, there's things like that come up, from time to time as well, and where we can be a good resource. So final thoughts are just, we try to be a great resource for nonprofits, especially in the area of planned giving and endowment management. It's just, you should be motivated to think about, including planned giving as part of your workflow. It's important. There's a lot of money moving between generations. It's just, it's something that I wake up, in the mornings, excited to, come to work because of that. And again, have a plan, have meetings, one-on-one, face-to-face, or Zoom or whatever, but have actual meetings and actually ask them to make gifts. And then, consider how either a long-term fund or an endowment fund might be a good tool. So at this point, we've got our contact information up. We're open to any questions that you want to send us after, but at this point too, Corey, are there any ones you want us to address now?
Yeah, so I think the only question here that I don't think was touched on is we had a couple questions involving how to structure endowment campaigns and more specifically, maybe 3 to 5 things that would need to be in place before they started an intentional plan giving program.
I don't know, I think we covered that.
I mean, yeah, definitely
I would,
finding the purpose
yeah.
or the goals,
I would-
knowing who's going to be responsible, obviously getting your board's approval, you don't just want the staff to go do this on their own, at least go and talk about it with the board to make sure that, they're on board with it. And again, an important reason to do that with the board is because you're going to want to ask them to be supporters of this
Right.
and be examples of this, so that, so those would be probably the two, 2 or 3 things that you want to have, before heading into any sort of campaign. But then, I didn't use the terminology, but, I would also probably spend a little bit of time thinking about the concentric circles of your best friends, who are that very closest core best friends, who then are the concentric circle that's a little bit bigger, maybe not quite as close. And then, define what those bigger concentric circles are until you get to the point where all of your constituents are in that sort of outside concentric circle. And the reason you want to think about that is because you're going to have different approaches, like, maybe one-on-one conversations for the first 3 concentric circles, and then it may be just putting it in the newsletter or the website, or mentioning it at events. Maybe that's the only way that you can really get it to all the constituents, it's sort of those more broad communications things. But you want to think about what are the ways in each circle that these people will know that we're doing this. So
I think it's an excellent goal to have, right? To say that our organization has very minimal endowment. And that's kind of the rainy day fund, whether drawing, 5% from it every year to help fill certain needs in our budget, or in case of some kind of fiscal issue. Great goal, but it's sort of, empty without the story about, well, why does an organization want to grow endowment? It's a lot easier for people to see, I want to build that building. I need a accessible building. I need that elevator. So why do you want to grow the endowment? Tell me, as a donor or as a professional advisor to a donor, tell me, what are you going to use the endowment for? It's, plenty of organizations say, we don't have an endowment. We're under endowed for an organization of our size. We need endowment. We need endowment. Well, that's good, but it doesn't just, and I like that awareness, but it doesn't stop there. How am I going to grow the endowment, and why am I going to grow the endowment? Plan giving is got to be part of that discussion, because over time, your endowment will build by virtue of those planned gifts. And people can leverage bigger gifts through planned gifts of life insurance beneficiary designation. Then they can write checks for it.
And one thing I didn't mention before, but the average national average of a planned gift is somewhere in the $35,000 to $50,000 range, which is substantial. But from time to time, you may get $1 million or 100,000 or 250,000. You never know what might come, but yeah, I mean, like, if you can think about that. So say, you start getting 1 or 2 or 3 $35,000 average gifts, a year, over time, that definitely builds up. And with the right choice of putting some of that or all of it aside for long-term needs make a big difference. So, any other questions, Corey, or?
Yeah, so you had mentioned the community foundation's gift acceptance policy. Would you like anyone who's looking to kind of overview that to email you directly, or is that something you want to include in the follow-up?
No, you can just email me directly on that for anybody that needs that.
And yeah, that looks like it's everything.
Awesome.
Cool.
Well, thanks, everybody. This was great. It was good to be able to go through this again. Good to be with my buddy Christine, and
My pleasure. Thanks to Danielle and Corey for our super duper tech assistance.
yes, absolutely.
Thanks so much.
Cool.
Have a great day, everybody.
Thank you, everyone.
Bye-bye.